host for tonight. Manoj Jatri, I'm a realtor with Remax Hallmark Realty Limited. And welcome to our webinar. It's been quite a while, but we are back and we have our mortgage expert with us today. And let's first get a hi from him, and then I will start walking you through what we are doing for today. Hi, Faisal. How are you, sir?
I am good, sir. How are you?
Wonderful. Okay, so finally we are back, and we are back after quite a while. It has been a hectic summer, and I mean, I was trying to put it together for numerous times, but something or the other kept on creeping, and I was just not able to get back. But I think so. We are back. Last week was a glitch, but now we are going to be very regularly. So we apologize to our subscribers. Go ahead.
Thank you again for joining us. Yes, we're back after some time. Apologies for that. However, we've come here again with lots of great material, lots of information, lots of knowledge, and everything you need to know regarding real estate and financing.
Absolutely. And let me congratulate both of us. Today we have 100 subscribers.
Wow.
So we reached the three-digit
Three-digit mark
today. Okay, ladies and gentlemen, I will start with the agenda of the day. You can mute yourself, and then I will keep on calling you back and forth as we go along. So
Awesome.
Let's head over to the agenda of our day today, and let's see where we are, and then I'll start rolling you. Ladies and gentlemen, as I've showed you numerous times, I will start with my real estate monologue. And today we are going to cover some information on real estate. And as you know that the federal elections are due, happening on the 21st of October. And we'll try to pick up some of the things there. And then we will get back to our rent-to-own topic and see where things are. So we will be covering the real estate, the federal elections, and the first-time home buyers incentive. So that is the most, we'll take all the info of the expert, mortgage expert, Faisal Garcia there, and so that you understand there. Then we will complete our main topic, which is our rent-to-own homes real, and that is the agenda for the today, including the live interview with the mortgage expert. He will be on deck today for each and everything that we are going to go today. So that is at this moment is the part and parcel of our agenda for today. And let's see if I can get our first topic on board, because that's the most important one. And let me see if I can take you there now. Okay, so this is because of the federal elections, this is the first main topic that I have picked it up, and that is from the CBC News. In some battleground ridings, renters spend 50% or more of their income on housing. So let's, and this is like a post done by Shanifa Nasser on September of 17, 2019. So we are going to review this one for our some of the interesting article write-ups that she has written there. Let me get the expert there, and let me share something out with him. And in some battleground ridings, renters spend 50% or more of income on housing. Faisal sir,
yeah,
let's start with this topic of renting. What are your thoughts on it, and then I'll give my 2 cents on it.
Well, what the writer has said is pretty much a fact. It has been for last noticeably, I mean, it has always been there, but noticeably for last 12 months or so. Um, Fierce competition, the cost of renting an apartment, condo, whatever you're renting, is so high that yes, most of your income is going towards renting. And no questions, this headline of this article is a eye catcher.
Okay, I'll take a more deeper version on it, and I'll give you, because this is like something which has messed up the entire Toronto real estate market. In fact, similar to Uber, what they did to the taxi format, I have like you remember the entire Toronto real estate went absolutely off from 2016 2017 when Airbnb came into the picture.
Yes.
And they have literally messed us up. And now the government has not been able to rein in with this Airbnb properly. And they literally, the supply and the demand is not there. And but obvious, these headlines will come into the pictures. In some battleground riding, renters spend 50% or more of their income on housing. Yeah, absolutely yes. Because as you can see, I mean, like, I've gone through so many articles in these few weeks. You cannot afford anything in Toronto. There is nothing. And this particular article, let me go dwell further into this particular one, and you will see, I mean, incomes, and that is why, like, UBS also came up with, like, Toronto has become the most, it's the second city in the world, which is like now expecting a bubble, real estate bubble there. So let me just go further into this particular article and then get you back there. Give me 1 second here. So now, of the 20 ridings with the toughest affordability challenges, 11 are in Ontario. Can you imagine this? Out of 20, 11 are in Ontario. And out of these, of the ridings identified in the index, Willowdale in Toronto was the worst for renter affordability. 39% of renters there reported spending half of more of their income towards rent. And the reason I'm picking up these particular ones at this particular stage is that the federal government will have to come up and do something about it, because you cannot rein in with Airbnb. You cannot control them completely out of whack, and the supply and demand is not there. So many things are going on, which is absolutely. Let's head over to this particular one, and then I'll take your views on this one. Among immigrants now renting shelter who landed in Canada from 2011 to 2016, nearly 24% were found to be at a crisis level in terms of the percentage of household income spent on shelter. 24%, and they just landed. Once you land in a new country, it is a toll in itself. You take your time to settle down. In terms of overcrowding and overspending, the hardest hit immigrant-led households are in the Greater Toronto area. Let's get your input on this particular one before we go to the next one. Go ahead, sir.
Those numbers are definitely there. Now these are probably the numbers that are reported. There are so many others that are under the radar that don't even come into the reporting, and they don't even get counted. So those numbers to me are great, but they may be even worse. And yes, you're right. Airbnb has taken the demand, essentially the supply, out of the market, because that supply of housing is being used, like part of the supply of the housing is used towards Airbnb, there is no new supply, and therefore demand is outstripping the supply.
Absolutely. See, the whole structure needs revamping. Like people, like let's say suppose you are renting your house or a particular portion of your house for $2,000 per month, and now with Airbnb, you do not have landlord and tenancy issues. You can make that $2,000 maybe within a week. Why would you take the hassle for renting long term? So this equation has messed us up incompletely, and thereby even a lot of supply has gone off. And apart from renting, I mean, like we're just picking up on renting, but I was reading another article there which says more than 1 million homes are vacant in the entire country. So they will have to do something. I mean, all these, like small problems have become a very gigantic equation here, which needs to be resolved by someone. Okay, let's go further into this particular article there. Give me a moment here. In terms of overcrowding, with 55 to 60% of those households in Richmond Hill, Vaughan and Markham spending 30% or more of their income on rent. And to tell you, like apart from spending, if you go and look for a property, you are going to go through a nightmare finding a property to rent these days in the market.
Exactly.
But those suburbs still might be more affordable options for those looking to own a home in Toronto. Best obvious, yes. Now, this is an example by a person who was trying to buy a property. Have a look at her example and you'll be amazed. It's a great idea. She was trying to buy a property for $800,000, which is not realistic anymore in Toronto. Can you imagine this? $800,000. And all of this has changed in the past 3 to 4 years. I'm seeing almost from 2016 to 2019 when Toronto has become absolutely, and even then, read the next line. She went and put an offer and there were 6 other offers and the property sold for $840 and she was only approved for $745. So even if you have a $700 or $800, you cannot buy properties. There is something someone will have to come in over, because lots of these equations are not the right equations. There is some and the reason we are picking it up at this particular point of time is renting vacant properties, and the cost of living in Toronto has become very difficult. And someone, I mean, they are experts. I mean, like there are so many experts there in the market. They will have to do something. Go ahead, sir. Your thoughts on it?
It's a challenging market. Whether you say rental or purchase, it has its own kinks. Rental is definitely has become a lot more competitive. Landlords now have options, quite a bit of options, and tenants are out of luck if they don't fit the box this market has created for them. The box, when I say box, I'm talking about a checklist. Let's say good credit, stable income, permanent full-time job, first and last. In some cases, first and last and deposit, security deposit, and the whole 9 yard. I've talked to someone, and this person has managed a building. So he was almost like an assistant super, and he said that it's best for the landlord for the tenant to leave, fix the apartment, like paint it, so on, and then rent it for a lot higher in today's market rather than increase the rent. Yeah.
Yeah, absolutely right there. I just missed on a thought there. Okay, I'll get back to on that particular one. Now, the real estate board and some of the associations have come up with a 4-point program, and let me take you there. Okay, so let's see what has been said by the news release. Realtors Association from Canada's largest real estate markets are calling on all levels of government to take meaningful action to make home ownership more accessible to people across the country. So they have come up with a 4-pointer, and let's go one by one and see if any one of them will be making some sense or not. Okay, so the first one is revise the Office of the Superintendent of Financial Institution OSFI mortgage stress test to take into account its impact on different real estate markets across the country. The federal government should view the stress test as a flexible policy and adjust it based on the changing economic trends and interest rates. So basically, now this is like by a news release by the Toronto Real Estate Board, and on September 12th. Now they are saying to address the stress test. Let me take your thought process on that particular one. So the first one is the stress test. How I mean, will the yes, but obviously we know they brought the stress test there to rain down the high prices, but I don't think so it has worked.
It has worked in some instances, and it has definitely worked for higher price point properties.
Okay.
However, when you go into higher price point properties, you're also working with clients of different caliber. They have higher down payment. They have, their incomes are in a different bracket. Now, when I say that, I'm talking about over $1 million properties, of course.
But the main thing is, okay, you have picked up the right point for the higher income properties. Even at 800, the example that I showed you, there are hardly any properties in the $600,000-$700,000 range here in Toronto. So now, I mean, these people have to go out anyway. Outskirts are the only options left.
Yes.
So I mean, you are more into, because you do it on a daily basis, the stress level is like now they are telling, okay, like, to revise this mortgage stress test. Do you think if they come back to the original format before the stress test, will that be more effective? With the whole market has now completely changed.
Exactly. Because the market has changed, it's hard to say. But if you look at the reality, it was definitely affordable when there was no stress test.
Yes.
Compared to today.
I mean, I've seen within like from 2017 January onwards, I could say, or 2016 also. This is like a 3-year run. That is, we are on a wild run here.
Yep.
And that is where things are. Okay, let me see if I can pick up the article further there. Go to the next point there. Replace the $750 first-time home buyer's tax credit with a $2,500 non-refundable tax credit for the first-time home buyers. How much will this do?
Not a whole lot.
Nothing.
Not a whole lot. It's a tax credit. It's at the lawyer's office. Does not really affect the approval.
Yes, approval is not affected. I mean, they may have to give some less money for the down deposit,
closing
or closing cost and things like that. And now let's pick up the next one, which I think so. From my point of view, may work. Reintroduce the 30-year mortgage amortizations. I would think, let me get back to you on this one. I think instead of even 30, I mean, they used 30 is there, still there when you are doing 20% down. Is that right?
Yes.
they should go for 35. What do you say on that particular?
Initially 2008 it was 40 years, 40.
Perfect.
So, and at this moment, having 20% get 30 years, having 15 or 10 or 5 get 25. It's really harder for people that have
Already
less
in
down
stress.
payment.
Yes.
Yeah. And then add stress test. I think if anything, they both should be at 30. Yeah.
And if you have 20% down, you can even go further.
Yes.
I think so. From my point of, like from whatever I have been able to, they have to come up with some solution for Airbnb, and they have to come up with some solution for properties which are lying vacant in the market, which no one like they had introduced it in Vancouver. And the third one is these mortgage amortization should be there. They should go maximum. I think so, like, because it's you cannot afford anything here. You cannot get qualified for anything in here. Okay, so now let's go to the last one and let's see if I can get something in here. Consider regional differences when implementing nationwide measures that affect home buyers. Absolutely yes. They cannot have one kind of a rule for the entire country. They will have to take Toronto and Vancouver market way different than the rest of the country. So, and I have also heard that even the first time home buyers incentive, they were trying to go for around 789 or 790 for Toronto and maybe Vancouver. I'm not aware of that, but I mean, like, so that you can purchase more higher, because that's the realistic numbers. There is no properties in the $500,000 or less range. I mean, even absolutely nothing. In fact, condos downtown are now in the $600,000-700,000 range.
Yes.
Okay, so now let's get to the first time home buyers incentive. Let me see if I can get that one and see if we can pull this one out and see if this is making some sense or not. Okay, give me a moment here. Yes, so I have it here. 6 things. Now this is a BNN Bloomberg article by Nicole Giuliani. I hope I got that right. And this is what it is saying: 6 things to know about Trudeau's first-time home buyer incentives. Let's go ahead. Ottawa has earmarked $1.25 billion over 3 years for the first-time home buyers incentive. Now, let me ask you, is that sufficient enough, or is the time frame enough? 1.25 billion for 3 years, when CMHC is what do you have to say on that?
Dollar amount wise, it seems fine. The challenge I am having, and with current clients that I have, qualifying for that program, the qualifications are extremely stringent.
Oh, yes.
So,
I forgot to ask you, have you done a few of them now?
I have done one.
Okay.
I have tried 4 in total. 1 has worked.
Okay, and why didn't the other 3 work?
It's the income qualification ratio, many different things. There is a good list to follow, and on top of it, the approval takes long. It's a process. Let's just say
nothing is happening within the 5 days of conditions.
Oh no!
It has to have a pre-approval.
Pre-approval, and client has to be very organized, and taxes have to be up to date, and the whole bit. It's a process.
So let me understand. So the client is coming up with 5%, and the government is giving 5%. Is that right?
Exactly. Yeah.
That's the whole format of the program. How much is the amortization number of years? 25 or 30?
25.
25. Okay. And they can only qualify up to 480.
Mm-hmm.
And the income has to be 120.
Cannot be more than 120.
Wow. So your income cannot be more than that. It has to be below that?
Yes. There is a ratio. It has to be under 4. So 120 is 480, which means, let's say if you were to have income of 125, you've crossed the mark of 4, which means you don't qualify.
What? And so, I mean, let's say suppose someone's income is 110.
Mm-hmm.
Do they qualify?
That's okay. Yes.
Okay, so they cannot go beyond 120.
Yes.
Wow. That is like I mean, wouldn't it should be like even if you have 125, you're trying to buy a property only up to 480. Should qualify.
Doesn't work. Doesn't work.
Doesn't work. Oh, okay. Good info to know. Okay, and then have they like, okay, so now when you sell the property,
Mm-hmm.
you have to pay 5% of the sale price.
Yes.
So you like, let's say for argument's sake, you bought the property for 500 just to round it about, and then it sells for 600. So now you have to pay $30,000 to the government.
Yes.
As a shared equity plan.
Yes.
Okay, so basically, I mean, try to walk me through here.
Mm-hmm.
So let's say suppose a person bought it for 480 and he sells it for 600.
Okay.
120 is the profit.
Mm-hmm.
Okay, and let's say suppose 3 or 4 years have gone into it. Now, $30,000 he has to give it to the government.
Mm-hmm.
$30,000 to $35,000 will go in real estate fees.
Mm-hmm.
So he's left with 50 or 60.
Exactly.
Why cannot he even take a private mortgage and he may even end up paying less in interest? Am I sounding right?
Yeah, private mortgages, I mean, they need a higher down payment. 5% doesn't work for them.
No, I'm just saying, just for difference calculation.
Argument's sake, yeah.
Argument's sake.
We would have to run the calculation to see.
Because I mean, $30,000 is not a small change.
I mean, see, when the prices go up, you're right. But if the prices go down, it has you're still paying just 5% or 10%, whatever you borrow.
Okay, hold on. Let me ask you this thing. Okay, so let's say suppose this is not going to happen, but just for argument's sake, you bought the property for 480 and now in 3 years' time it is 450. What do? Do you pay back the government or you don't pay anything?
No, you do pay.
And how much do you pay?
5% of the sale price.
So again for 450, you will have to pay 5%?
Yes. Because
wow.
you took 5% from the government.
So 5% of that particular amount you still have to pay?
Sale price, yes.
Oh, that can be tremendously risky.
It's a shared equity plan.
It's a shared equity plan, I understand. So it's like basically the government is your partner.
Silent partner,
Silent partner, okay. Good to know. There were, I was thinking like once we get into one of the things, then we may get the whole gist of 9 yards on that particular one. But anyway, let's go further into this particular article and see. Okay, that we have just covered. So it's basically a shared equity plan. That is what we have said. So government is a silent partner and they will take 5% of your resale home, and so not all buyers will qualify. Okay, the expert did cover on that particular one. So if your income is above this particular one, then you are not qualifying. Wow. Okay. Now, let me ask you something here. There is a talk that's going on that I mean, after the federal elections are done, that then in Toronto they may be like going over to 789 or 786 or somewhere there. What exactly? I mean, how do you think that it's pretty serious there?
I would like to say it's very much speculation.
Okay, so we may get it, we may not get it. I mean, like, huh?
We may. It's very much a talk. So
And let's say, suppose if they go with the 790 or $800,000, what is the income that they are now working with then? All the way
I
up to
hope
200?
I hope they revise it, but we at the moment would not know. That is not. See, it's a program that is very new. Yes, there are guidelines, and I was in CMHC's webinar, and it was made very clear that there will be no exceptions. So either you fit in the checklist or you don't. So of course, if the dollar amount is revised, the income will get revised, all the other things, and we may have another aspect to add it to that list.
See,
So we don't know.
if it goes to 790 or 800, I mean, after $500,000, you anyway require 10% down.
Yes.
How will that work? Because so lots of things are in flux.
Lots of questions on
Lots of
that.
questions are in flux. Okay, let's see what is the next point on this particular one. It is not feasible in every market, but obviously we have just told you Toronto may not come into it. Okay, you have to pay it back. Okay, let's ask you on this particular one. Borrowers must pay the CMHC back after 25 years or once the home sells. You can also pay back the loan early without penalty. Can you elaborate on these two things? So what happens is someone doesn't sell for 25 years. It's not going to happen because you generally tend to sell it.
Yeah.
But let's say, for argument's sake, if someone keeps the house for 25 years, what happens?
If they keep the house for 25 years and they do not want to sell at the end of the agreed contract, there is an appraisal ordered.
Okay.
And client pays for the appraisal, and the appraisal has to have certain designation, and that appraisal is being given to the CMHC, and then CMHC does the calculation and tells you this is how much you owe. You pay them, and that's when they release their interest in the property.
Okay, and the same one would run into you can also pay back the loan early without penalty. So same equation, I would say.
Exact same.
Okay. Okay, so in both the cases, the whole equation will remain the same. Okay, now let's see. For buyers with little equity, selling after a big price correction and covering all your costs such as realtor fees, paying out the mortgage and covering closing costs is difficult. It is therefore less likely the government will ever actually absorb part of your losses if prices drive. Okay, so this is what we have just covered. If there is a price drop, then you are on the hook. Okay, now let me ask you here something. This is an interesting. Let's say suppose the prices have dropped and you do not have the funds. What will the government do? Well, what happens in a power of sale? Will they do a power of sale?
They have a lien on the property. There is a second lien on the property.
No, that's what I'm saying. Let's say suppose someone is, okay, what happens is someone is not able to pay the mortgage. What does the CMHC do? And they just walk away.
No, they get their share. There is a lien on the property. The home will not get sold. The transaction will not close unless they are paid.
Okay, I have understood that particular part. But let's say suppose the market has dived badly. Okay, and now they have a certain portion that is there. But the market has dropped substantially and the person who owed that particular property has already walked away. Let's, for argument's sake, the property was 500. Now it is 400. The person has left the property and walked away. What does the government do?
It will be at the lawyer's desk and they will have to figure out something.
So they haven't specified, I mean, in the case of a loss or something.
I mean, this is how I can make sense. If there is an actual loss and there is an arm's length sale, which is power of sale, arm's length, then they will probably take a loss. of that many percent.
Yes, because there has to be something of the sort. Because see, the main thing here is only two people money is there, the bank
And the government.
and the CMHC.
Yeah.
So that is, I mean, see, isn't it that there is a conflict of interest here, because they are the insurers and they're also equity share plan holders here. Probably we are going too much more into it than necessary.
I think
Because
it can be looked that way, but it's not at the moment.
They must probably with more examples coming into the market, will be able to see more.
Yeah.
Okay, let's see what else is there on this particular article. It can save you money on more than just your mortgage payments. Yes, that would be the only thing. But okay, now I was going through this particular one. It can save you money. How much money does it actually save?
It's essentially a 5%.
Okay.
If you were to put, it's about $225, $300.
$225, $300 per month. Is that right?
At the most.
At the most. Okay, let me ask you here. We'll run into the round numbers. $500,000 property.
As we speak, I'm doing the calculation to give you the numbers.
Okay, $500,000 property. The government is putting $25,000 down. How much is the interest, or are they charging interest only or principal plus interest?
There is no payment back. So there is no payment for the time that you have that government incentive.
Okay, let me ask you in a different way. Let's say suppose the mortgage amount is $25,000. How much do you pay per month? I mean, from my point of view, it should not be more than $125.
Yeah, I can tell you that.
See, in round numbers, for every $100,000, the mortgage is $500.
Yes.
So for $25,000, it should be $125.
$118.42 with today's interest rate.
I'm just rounding it to $125. So $125 into an year, you're only talking what, $1,000 or $1,200, and you are just basically saving $1,200 per year, and you have to give them $25,000 or $30,000 if the property increases.
Yes,
doesn't make sense. This equity shared plan, I mean, like I don't think so. Like when you did your examples, what were your feedback on that particular one? I mean, from my point of view, I mean, like it doesn't look, the numbers don't work.
See, we always look at things differently.
Okay.
For clients, it's looked at it differently. If they don't qualify with 5%, but they qualify with 10% down.
Okay, makes sense.
It changes the game for them.
It changes the game for them. And the main thing here is there is no one else in the market who will give you 5%.
Yes.
Because that will make you reach all the way to 95.
Exactly.
Okay, so it is like it's a quite a bind there. Okay, one more second. Let me see if I can read anything more into it. Level of interest in the program is unknown. Now, the incentive is expected to help $100,000 family purchase there over the next 3 years. Yes, it may be. This may be true that $100,000 families may be able to do it, but you're not talking about the GTA or anything. It should be in the outskirts, I would say.
Well, you can't find a property under 480.
There's nothing there.
No.
Nothing there. Okay, so this brings us almost to the end of our article rounds, and let's see if we can now dwell into our main topic of the day, and let's see if I can. Anything you want to add before we move on from this first-time home buyers incentive?
First-time home buyers incentive is a great program, but it has a lot of um, conditions to go through. So I would suggest clients have enough time to go through the entire processing. It takes time.
It takes time, and basically, you have to have all your documents in there. You have to have the approval in place. Everything should be absolutely done before you go and start seeing properties or start putting in offers.
Exactly.
Because nothing is going to happen in the 5 days of conditions. And
have all documents on hand, everything on hand. We would be lucky if we can get everything through 5 days.
Okay, let's dwell into our article of the day. So that is where we are, and that is where we are going to go next. Okay, let's see if my PowerPoint starts responding. It has just gone into a freeze. So give it a moment or two, and I hope to get it working. Okay, let me see. Till it gets started, if you want to dwell further into this particular one, you want to talk more about it, let me see when I get this particular article rolling back again. Anything else you have to add to this first-time home buyers program?
First-time homebuyers program has definitely, what it has done is it has given a bit of a boost to the properties that are outside Toronto that are affordable. So that's one. Number two is it has helped single individuals get into condo units. Of course, not in downtown core, but a little bit outside, outskirts, Scarborough, you're talking Hamilton, so on and so forth. A little bit outside, just outside GTA, let's say, is the prime type of properties. If you needed co-signers for if your income was just enough, but there was a bit of a shortfall and you needed co-signers, it has helped clients avoid that. Those are few things where first-time home buyers have helped. But predominantly, I do suggest clients, since I've gone through 4 of the applications, I've seen one thing, it's a slow process and it's a big process. So be ready, lots of documents, everything has to go through the system, and the rules are stringent.
Now, whom are you in touch with? Are you in touch with the lender or are you in touch with the CMHC directly?
Lender and CMHC. Lender communicates with CMHC, and lender applies at the same time the insurance is applied.
Okay. So, and in case if you need to talk directly to CMHC, are you like hands-on on there, or?
That it's not. It's a checklist we give. Documents are asked for, so it's a bit of a different process. But no, CMHC is not directly in touch with us. It's through the lenders only.
Okay. Let me see.
For now.
For now, okay.
It may change. I'm not sure, but for now, that's where it is.
Okay. So now I think so I have managed to get my PowerPoint presentation slides back. Let me just head into it so we can wrap it up on time. And let's head over. So this is our main topic of the day. That is where we are. Are rent to own homes real? Because lots of time whenever we are talking to anyone and explaining to them, they always ask us this particular question very much. Are these homes real? Yes, from our point of view, they are very real. But the thing is, it is the worst case scenario and it is the last resort. So I'm going to pick up on those particular ones, and let me from the first thing is, let me explain it to you what exactly is rent to own homes in simple terms, because there is a major confusion that people think like, okay, you can just pay the first and last and get into a property, and that is not the case. So that is where I am heading to explain you what exactly it means in simple terms. Okay, in simple terms, rent to own means you're not buying today but tomorrow. This is as simple as I can make it over. That means this tomorrow can be anywhere from 1 to 5 years depending upon your situations. And now let's see what exactly I mean. So 1 to 5 year term is your rent to own options. And second thing is, you will have to buy the property after the end of the term. So you have to understand there is a term here, own, rent to own. So basically you have to buy at the end of the term. So from day one, you have to qualify to buy that particular property. So it is not that we are going to speculate on your income. We're not going to speculate on the down payment. We're not going to speculate on the purchase price in 5 years, what is going to be your income in 5 years, and on that particular basis you can do it. Everything has to be done on the basis where you will be able to qualify for a property on the basis of the income that you have today, not tomorrow. So these are some of the things in simple terms regarding rent to own. Now let me walk you through. This is because I always start from let me take the update from our expert there. Was I clear? I mean, is there anything you would like to add?
No, it's important to know that it is a term and it's going to end at some point, which is where you have to buy.
Yes,
because if you don't buy, you're in a worst scenario than you started initially.
That is what I wanted to explain in that particular slide. Is there is a buying component added to this particular term, rent to own. At the end of the term, you have to purchase the property.
Mm-hmm.
Okay, so let's see. Let's go further. And now, this is the reason I have always told, before you indulge into it, before you do anything about it, it is a worst case scenario. Now let me explain you why it is a worst case scenario, so now you can understand and comprehend. You're not able to procure a mortgage. Okay, so that particular scenario is not there. And no one is even giving you a place to rent. You're not able to even procure a property for renting. You have ran out of all your options there. So there is a messed up somewhere in your renting format or something, and your mortgage is issues with your bad credit or income scenarios, or any income I wouldn't say, but the credit issue is a big deal. And that means now you're thinking over, is there any other alternative left in the market? And that is when you will look into a rent to own home program, because, and that is the reason I'm explaining you this is a worst case scenario, is you end up spending 2 or 3 months going through the whole task, and then you suddenly say, no, it doesn't work for me. We are already telling you from day one, slide one, that it is a worst case scenario. And now if you're in a worst case scenario, yes, we can address this and we can handle this for you. Let's take the experts' advice on this one. Go ahead.
Buying versus rent to own. Well, rent to own, you are the responsible owner, even though you don't have the title of the home, and you're responsible for everything, all the expenses. The rent plus the ownership part of it, because there's a piece that goes, there's a dollar amount that goes towards your down payment. So rent to own, monthly payments are higher.
Absolutely. Let me get back to the third slide. Okay, now this is the most important one that I'm going to explain it to you so that you can understand this particular one. What exactly is the real difference between buying versus rent to own? And this has to be understood very, very clearly, because the reason is this is where the problem occurs, that you're not able to comprehend exactly what is exactly everything else. Everything within buying and rent to own remains the same except the credit score. So I've pointed it out here clearly. Everything remains the same except your credit score. So your income qualifications remains the same, your down payment issues will more or less remain the same, and the only difference will be your credit score. That means, let's say suppose you have a good income, you have down payment, but the credit score is 400 or 500. So till the time you can take it over from 400 to 650 or above, where you can procure a mortgage, you can do the rent to own format. So that is where is the basic difference between these two. The income criteria and the down payment requirements for both remain the same. So that's what I was explaining it to you. I mean, we are not going to speculate on your income. If your income is 120 or 125, you'll qualify 4 times the income, and that is, you can go all the way up to any property up to $500,000. Down payment requirements, 5 to 7% will remain in there. And now, because you're repairing your credit, you may have come out of consumer proposal, you may have come out of bankruptcy, you have initially 5 or 7, and in the time frame till your credit is repaired, you are adding another 4 or 5%. So now with 10% down, you may be able to procure a property. And you have to also remember, any property which you are buying today, which is 500, has an appreciation value, and it may go all the way up to 600 or 650 in 4 or 5 years term. So you have to qualify on the basis of the final amount that you have to procure to for the mortgage. The only difference is the credit score. So this is the real difference between buying versus rent to own. And the reason I was wanting to explain this particular one, because the rent to own term has not been clearly understood by the market, and that is the reason that both of them, I mean, you basically from day one have to start with the buying criteria and then repairing the credit for the term. And the term of the rent to own is the term that you have to do for fixing your credit. Let's get the experts update on this one. Did I clearly explain that? You're mute here.
Yes, income and down payment criterias don't change. The only difference is credit score.
Yeah, you're just repairing the credit. And whatever time it takes you to repair the credit, that is the term of the rent to own. It is as, I mean, I could not go further simple on this particular one.
Income can stay same or go higher, but if it goes down, that's a challenge.
Oh, that will become a nightmare.
That's a challenge.
And also, like, let's say suppose you buy a property for 500 and you're doing it for 3 or 4 years for rent to own for 600, you should be able to qualify for 600. And that is why you have to start with some kind of a down payment, so that with 10% down payment, you can procure that particular property down the line. So it is another challenge. It is the same as the government challenge program. It is another alternative there. Go ahead, sir.
Yeah, I mean, it works for some clients.
Not all. Yes, not all.
Not all. I like to say it's a distinct product.
Absolutely. Wonderful. Yeah. Let's head on to the next slide and see if I can walk further on this particular one. The rent to own program is very real, but indulge with your eyes completely open and with proper representation. Make sure you are properly knowledgeable about it. You have the lawyers, the real estate agent, and you go through each and everything because there are lots of things in the market, and it is not this program varies with various companies. So it is in your interest to be very have complete knowledge with your eyes completely open, and know-how is there, and proper documentation and representation is there. Okay, now this is the one that we feel the best way to analyze it. If your credit score is 600 and above, go for a mortgage right away. Do not go for a rent to own program, because we should be able to get a mortgage for you. If your credit score is between 500 and 600, it will be much faster you get your credit repair done. Faisal is an expert in credit repair, and I would strongly advise you to take his services there and get the credit repair done, because it will be much faster than a rent to own program. Now, if it is below 500, yes, that is the time this one program has some kind of a relevancy. And again, understand, it's the worst case scenario, and it is the most costliest program, and it is the worst case scenario. And in case if you're below 500 and you understand that it will take you 2 or 3 years to come back into the market, maybe you want to jump into it, you work out all the numbers, and if the numbers work, then you can look into it. Let me get the experts expert on this one.
That's a very good slide to go through. Yeah, below 500, that's where the eligibility starts to look more feasible. But 5 to 6, we can fix the credit faster and get you a mortgage.
Yeah, I mean, if I'm not wrong, within 3 to 6 months, it can be done between 500 to even faster, I would say, depending upon the situation.
Yeah, depending upon how bad scenario is, but 4 to 5 months should be done.
Should be done. Okay, let's head into the next slide there and see what we can walk you through further. Okay, now, is the rent to own homes a good idea? And this is I'll give you a brief on this one and a faster one. Let's say suppose you purchase a property for a $400,000 price, and the purchase price is, and the appreciation is, let's say suppose 5%. I'm just taking round numbers to make it easy and explain it to you. And after 5 years, the property purchase price is $500,000. Now, if this particular property, after 5 years, you can sell it for $600,000, yes, then it is a good idea. So it is only in one format I've seen that this one becomes a good idea. That is when the option price is the amount decided initially between the buyer and investor seller as the final purchase price. So people have generally asked me what exactly is the option price. This is the option price, which is decided on day one when you are trying to procure this particular property in the rent to own program. So if the market value goes above 600, then only this particular one becomes a good idea. Otherwise, rent to own homes is the worst. Yes, only if the market value is more than the option price, then it becomes a good. Otherwise, it does not. Now, I think so. We are almost like 2 minutes left. I will cover this fast with a condo example. And let's say suppose the price is 400, maintenance is 700, and taxes are around 300. You will require an income of $100,000 because you will qualify 4 times the income. So any property up to 400, you require 100. Down payment will be 20,000, closing cost 6, so you require $26,000. Now, if your credit is above 600, I would recommend you to go with it. And if your credit goes above even 700, we can also get you some